From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. And coming up, the Fed goes big, cutting rates by 50 basis points in a bid to defend the economy. Investors debating the pace of future rate cuts, with Chair Powell warning not to assume half-point moves as the norm. And treasuries are on back foot as they wrap up the most hype week in years. And we're going to begin with the big issue, digesting that 50 basis point cut.
The Fed really tried to thread the needle.
How do you do 50 without scaring people that you know something bad about the economy?
The press conference challenge was give 50 without spooking the market.
I think he did that very well.
Navigated that pretty well.
This is the dovish 50 basis point cut.
Probably a little less dovish than we thought.
Basically said, we're doing this because the news is good.
They said all this other stuff, but the reality was they did 50.
This is catch up. It's coming to terms with the fact that monetary policy is restrictive.
What has changed since July, when you decided not to cut rates?
I think they're going to be slow on this. We're going to get these 25s.
They're going to be very deliberate and data dependent.
When you go forward, it is a soft landing, baseline.
It's a soft landing kind of story, and I hope they can pull it off.
Now, I want to take a look at the U.S. 210 curve. Of course, this yield curve is the differential between the 10-year and the 2-year, and you're coming off really a historic inversion in the length that we've seen, disinverted now, steepening for a fifth straight week, which would be the longest streak since 2021, and now the steepest level since 2022. The question, this has normally coincided with some sort of recession. Do we see that this time around? We're going to talk more about those expectations, but we flip up the board first here and look at the changing expectations on that short end of the curve. You've seen that massive repricing in just the last couple of months, even just the last couple of weeks, as we drumbeated towards that 50 basis point rate cut. And you've seen the move well over 100 basis points just since the end of the second quarter. Now, Fed Chair Jay Powell spoke following the Fed's decision. Here is what he said.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. We're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate. You can take this as a sign of our commitment not to get behind.
Joining us now, Oksana Aronov of JPMorgan and Sonal Desai of Franklin Templeton. And you looked at that move in the short-term rates, 50 basis point cut as well, and you've seen a lot of volatility actually in the bond market since then. A lot of this is predicated on the question of how much, how soon. Where do you think, Oksana, we end the year?
So I think the bond market reaction so far has been quite interesting, especially at the long end of the curve. Earlier this week, I was saying that, look, the long end of the curve is already pricing in at that time 200 basis points of easing. And unless we see really a dramatic slowdown in this economy, how is this an appropriate level for the 10-year? And it's been very interesting to see that the 10-year has actually steadily moved up since this very anticipated and, in my opinion, a little bit too hasty 50 basis point cut, because, we just heard Jerome Powell talking about protecting the economy or not falling behind, making sure rates are not too restrictive. But we're not really seeing that in the economic data, right? Protecting it against what? GDP is doing great. Retail sales beat again this week. Industrial production beat. We are seeing really constructive points across the board, with the exception of a more normal labor market that went from just extraordinarily tight to slightly more normal levels.
Now, Sonal, to that end as well, this idea that did they even need 50 to begin with? We can sit here all day and ask, but what about the path forward? Do you think that they would need to go 50 in the November meeting as well, or do you think they slow down from here?
Absolutely not. I could not agree more with Oksana. This has been a view that I've held for a really long time. I don't think they needed to do 50. Fine, they did 50. But I thought Powell did try to calm the market down. Not quite sure what Governor Waller is doing today. I'm not sure at all, because there seems to be an attempt to take back any perceived hawkishness in Powell's statements. I think it's 25-25. And quite honestly, I have been calling for the long-term neutral rate to be closer to 375.4. Something else the Fed has been doing over the past several quarters has been inching up what its estimate of neutral is from less than 2.5 to close to 2.9. And I think that needs to go further up still.
I'm glad you brought us there because we have heard throughout the week a wide range here from investors on where they think our star is. Where do you think, Oksana?
So let's first of all establish the reality around the Fed funds rate, right? Because when Powell talks about going back to neutral, right, historically the average Fed funds rate is 5.6%. If we exclude the extremes of the early 1980s, we get to about the mid-fours, 4.6%, right? So that is still higher for much longer than I think the market is pricing in right now. In terms of our star, it's no longer got a two-handle on it, and the Fed is quietly moving towards that conclusion as well. It's sort of talking about 2% inflation, but really allowing the market to live with the idea of higher inflation. And as was mentioned, they moved from 2.2 at the end of last year now towards 3%, and that number will continue to move up. We are in the era of higher for longer. Not the least because of the effect of fiscal dominance, because that's really the other important issue, that is that we are now in the era of fiscal dominance that's going to keep a floor on our longer term rates and on the neutral rate as well.
You know, it's fascinating because even if you think we're anywhere above 2, the spread is still enormous. Sonal, you said as low as maybe 375. We've heard from Carlyle earlier this week that said that rate is closer to 4.5. There's still quite a delta.
Yeah.
So how much volatility do you expect in the year ahead as the market calibrates and the Fed calibrates what's neutral?
So I think, when we look at the year ahead, we can't really do it without looking at what is likely to happen via fiscal. And it is very likely to happen, and it doesn't depend particularly on the outcome of the elections in November, because we are seeing profligate fiscal desires, let's put it this way, from both parties. I keep hearing that I shouldn't worry so much because, after all, we're likely to have a split administration versus Congress. And the reality is we've lived with that for the last 2 years and, didn't seem to stop them from running up enormous fiscal deficits nonetheless. I mean, a sweep would be absolutely catastrophic. Yeah. So volatility, absolutely. But do I think that yields over the 5-10 year horizon are going to continue to face upward pressure? Yes, I do.
You know, it's interesting because if you look at the pricing in Fed futures here, if you go to WIRP on the terminal, you still see almost 200 basis points worth of rate cuts priced in through the end of next year. That would bring you to what? Just under 3%, around 284 is the implied rate here. That is still way lower than what we have been talking about here. So is the market getting something meaningfully wrong, or are they still just pricing in a landing that's harder than what we're talking about here?
So I think it's really hard to talk about the predictive function or the forecasting function of a bond market that's got $7 trillion worth of bonds still sitting on the Fed's balance sheet, which, by the way, was $3 trillion right after the great financial crisis. So somehow we're still here. So what is the market pricing in? I mean, I don't think you can really discount the reality of, nearly 15 years of mainlining liquidity, just endlessly, fiscal stimulus, really endless, where the Fed overstayed and continued to provide liquidity during periods when it's simply not needed. And so I do think there's a behavioral component to it where normalization is believed to be something, in the twos at the 10-year part of the curve. And I think that will prove to be elusive as more and more economic data comes in. It's really interesting, Sonal talked about the fiscal backdrop, right? So what have we seen so far? We have right now $1.9 trillion fiscal deficit, and we've seen some weak Treasury auctions periodically. And I think that is a phenomenon that will start to occur more and more frequently. And those expectations, the bond market will force the issue, and those expectations in terms of where long-term rates are will start to move up. And certainly over the next 10 years, when we look out, the rate backdrop, yes, there's going to be a lot of chop higher and lower, but broadly it will be higher, not lower.
Now, it's interesting, the fiscal impulse. Let's take another note on that, Sonal. You had Jamie Dimon, CEO of JPMorgan, saying at an event today at a festival in Washington that he is skeptical that inflation is going to go away so easily. For a lot of investors, that fiscal impulse is a big part of that story. Do you think that we stand here heading into 2025 having to worry potentially about inflation once again, once we see a new president, whether Republican or Democrat, take hold?
Yeah. The short answer is absolutely, because I never bought the idea. Now, belatedly, the IMF is also saying that, in fact, the previous round of inflation we saw had less to do with supply shocks and more to do with fiscal and monetary policy. And actually, I'd say that that's 100% in keeping with what we have been saying now for several years, that fiscal policy has played an enormous role in terms of demand. And I think it will continue to support demand. So the notion that I think there is a recency bias in the market. It's looking at that post-global financial crisis period as some kind, it seems to have some gravitational pull for practitioners that we're going to go back to that post-GFC, pre-COVID period of rates. And I think we're actually, that is recent, and that is recency bias, because there's 50 years of data before that, which would indicate that that's not where we are going. We're going back towards something which really is where the market was and where this economy was. There is no sign of deflationary concerns, which was, it was the mantra post-GFC, to worry about secular stagnation, deflation. These are just not clear and present dangers.
And I would also add to that the Fed has never, to my knowledge at least, acknowledged the link between their monetary policy and the inflation that we're seeing, right? And so in my mind, that means that there really hasn't been this come to Jesus moment for the Fed to say, look, maybe we did something wrong here, and maybe we need to reevaluate how we move forward. So when they talk about going back to neutral or becoming less restrictive, I question, what does that really mean? Because as was just said, the last 12 years, 15 years, that's not normal. That's the anomaly, right? Normal is where we are today, 5%, high fours. That's a lot more normal in terms of the bond market history.
Finally, investors getting used to or more used to higher for longer. Sonal Desai of Franklin Templeton, thank you very much. Oksana Aronov of JPMorgan sticking with us. Want to also bring you guys some breaking news here, because we have had some news come in at the top of the hour about the FTC suing CVS, Cigna, and United Health for manipulating insulin sales. And this was accusing these drug middlemen of engaging in illegal rebate programs, driving up the price of insulin and working with higher priced providers instead. We will bring you more news as we have it, but we do see a movement in CVS shares down 1.4%, United Health down 0.3%, Cigna still in the green. I also want to bring you some more headlines coming out of Germany, because of course this was highly contested. The German government deciding not to sell any more shares in Commerzbank for the time being. You have seen a movement in Commerzbank, of course, lower to the tune of 0.3%. And of course, within the country, since that initial sale, or set of sales rather, they have seen a tremendous amount of disagreement internally on how these sales were handled. Now, coming up next, we're going to talk about the auction block. U.S. high-grade sales for the month have already exceeded forecasts, but this week delivered the biggest forecast miss for any week this year. We're going to talk about the state of credit and what exactly is under the hood after the Fed's big move. This is Real Yield. Right, more here next on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where issuance was disrupted a bit by this week's big Fed decision. And starting in Treasuries, where we had two notable sales, a 10-year TIPS and a 20-year reopening, which was awarded at the lowest yield in more than a year. And the primary dealer award was the highest since February as demand trailed. Over in U.S. high-grade, supply this week was just above $12 billion, missing estimates for $25 billion. That is the biggest forecast missed for any week this year. Dealers, though, are calling for a bounce next week. We'll see how things go. And the average yield, two worst for junk bonds, is at its lowest in more than 2 years. This has helped drive a flurry of new deals, bringing in the monthly tally to $24 billion, up 34% since last September. Now, Megan Robson of BNP Paribas expects credit spreads to widen heading into the U.S. presidential election.
Our view heading into the next 6 to 8 weeks is bearish on credit. We think investors are sort of underappreciating policy risk. And typically, when you head into an election, you see volatility rise. And given you have a binary outcome with two very different implications, investors tend to de-risk their portfolios, reduce risk positions, and that causes credit spreads to widen. So heading into November, we do think credit spreads will widen.
Oksana Aronov of JPMorgan still with us. Also joining us, Stephen O, Global Head of Credit and Fixed Income at PineBridge. And given that setup so far, Stephen, would you buy junky debt at this point in time? Would you go down the credit spectrum if you think we're hitting a soft landing, or are you worried that maybe things might get worse out there?
Boy, when you first start up, I talk about junky debt. I guess we need a bit of a marketing upswing in terms of referring it to a semi-high yield, which it hasn't been for quite a while. I would say from a fundamental standpoint, all signs point toward continued support. You've got, default rates which are trending down, not up. You've got a slowing economy, but remember that high yield performs best typically in a slow but positive economic growth, not a fast economic growth. And I think what the Fed did in not only cutting rates, but really pointing toward a glide path that indicated strength and confidence in the economy going forward would all be supportive of high yield bonds and spreads. The counterpoint to that is if you look at where valuations are, particularly if there's been a massive rally in the CCC component, valuations are at best fair to somewhat overvalued. So the skew of probability of outcomes is that spread should widen from here. But should it widen and will it widen are two different things. And right now, I think there will continue to be strong support and appetite for leveraged finance credit generally, including high yield bonds and leveraged loans. And so from a net coupon basis for the rest of this year, we still see a return that approximates a yield minus type of return.
How worried are you about kind of the riskier parts of the credit market, given where we have seen kind of spreads compress to? There has been almost no risk, is it fair to say, baked into this market?
So the risk is definitely baked into the market. The market is not priced for the vulnerability and the risk, right? And so I think when we look at any investment, we have to think about what's priced in. When we look at high yield currently in the high 200s, in terms of its spread, some of the tightest levels we've ever seen within spitting distance of cash, frankly, not too far from it, right? What is priced in? Because you have a lot of companies in the space that probably shouldn't have made it through 2020, for example, that are still hanging out, but are going to really find it more difficult to find financing, even in a world where the Fed funds rate is 4.5, right? That's just not a world they're used to issuing debt in. And part of the reason we've seen some sort of lower credit resilience is because there continues to be demand in a market that's really been shrunk in terms of the supply. And we also know that something like 80% of high yield defaults occur with no relation to an immediate maturity wall coming up, right? It's basically just looking at the fundamentals of the company and suddenly realizing this is not a liquid investment. It's not an ongoing investment, can't really survive. So with all of that in mind, seeing defaults rise in high yield, they are definitely on the rise. They are just coming off of extraordinarily low levels, seeing interest rate coverage ratios fall, EBITDA fall, not in the entire sector, but definitely in some of these weaker areas. And what typically happens in high yield is that when a certain part of that market falls out of bed, it takes the entire market with it, right? We see this time and time again. So again, what is priced in? I do think investors will do well to hold some optionality back here because there will be much better entry points. As we continue to live in this higher for longer world, that is not a comfortable place for a junk-rated credit.
Well, to that end, I'm glad you brought that up because, how far do you have to see rates really decline, Stephen, in order to be comfortable with where we stand? If you think about the maturities really coming due next year, the year after, and if we don't get back to where we were before, there are many doubts, of course, and rightfully so, that we will, then what do you start to see really fall off the engine here if rates don't fall far enough, fast enough?
For the last couple of years, the high level of rates has not been much of a determinant in driving leveraged finance issuers into a default status. Companies have defaulted, the few that having more idiosyncratic business profile issues and problems and structural problems that they're dealing with. And so as we look out over the next several years, we don't see the pace of yields decline or rate cuts necessarily having a meaningful impact on driving incremental default rates. And in fact, default rates have already peaked in the high yield market and are on their way down, although there is a component of the leveraged finance market right now that's experiencing what's called liability management exercises, where losses are being imposed outside of defaults, and that's taking place. And then the other component of relatively high levels of leverage is really the growth in the private credit markets for businesses that have been over-levered but still structurally sound. Many of them have been able to refinance. So when we think about risk exposure in high yield market, there's a tendency to look at the broader index, but you really need to look at the lowest rung, the CCC components, the stress components, and that's where your cluster is. And we are at extremely low aggregate volumes of that amount.
Stephen, Oksana, we thank you both so much for your time. We could have gone an hour today with the new information that we have. Now, coming up next, we're going to talk about the final spread the week ahead. There's a lot of Federal Reserve speak coming up. We're going to parse through all of it for you. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Real Yield. It's time now for the final spread. The week ahead, coming up, many things. We all get global PMIs on Monday, plus a host of Fed speak from Raphael Bostic, Austin Goolsbee, and Neil Kashkari. Tuesday, U.S. consumer confidence figures and Bloomberg's Global Business Forum kicks off in New York City. Wednesday, we'll get a fresh read on U.S. home sales, new home sales. And Thursday, all eyes will be once again on Fed Chair Jay Powell speaking. On the data front, U.S. jobless claims that day and durable goods rolling out. Jobless claims more and more, and becoming an important data point. Every week we see them. Finally, Friday, the Fed's preferred inflation gauge, PCE, along with UMich sentiment data. For my final thought, let's take a closer look at that Fed speak in the pipeline. Remember, even just after today, hearing those remarks from Waller about inflation being the key decision, PCE at the end of the week is increasingly important. But remember, we also have folks like Austin Goolsbee speaking next week, Chicago Fed president, where the story about employment will be an even bigger question mark at the end of the day. Michael Barr, Fed chair of Fed supervision here, is also speaking next week. And of course, those bank capital rules in front and center. From New York, that does it from me. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.